going to, over the next 15 minutes or so, talk about supply chains. We're going to talk about how DP World is navigating everything from tariffs to regional stability and the geopolitics in the region as well. But let's just start talking about the trade flows. And everyone, I guess, in this room has felt the sort of tensions around the tariffs, talking about US, China in particular. And from your perspective at DP World, how has it impacted you and how have you managed to deal with these issues around the tariffs?
Yes, great question, and it's on everybody's mind still today. The lens we look through is trade, and that means we don't look at it economically, we really look at, bluntly speaking, about, how are the trade volumes flowing and changing? Because we're in the business of shipping, we're in the business of ports and terminals and logistics, and so it affects our business. So that's how we look at it. And, we're well into this year. Actually, we're 2.5 months away from the new year. There is no doubt that if you look at the import volumes, specifically from the Far East into the United States, they're actually down compared to last year. So the trade flows into the United States are actually reducing. Partly because there was a lot of front-loading of volumes happening before the current administration late last year. There was uncertainty, as we all know in the news, as the year progressed. And so some companies front-loaded more volumes, but there's no doubt that in the second half of this year, those volumes are reducing and are actually behind last year. But what we also see is that it has a cost impact. First and foremost, there's now reciprocal tariffs on vessels calling the United States made in China, and similarly on U.S. ownership into vessels calling China. And so they're penalizing each other both ways, so there's cost happening that way. And then, our customers, the shipping lines who are in the middle of this fire, they will, or they had to readjust networks, they had to redeploy ships, they had to make operational decisions, and that has cost a lot of money to them to make sure that trade could keep flowing. And then I think lastly, to answer this specific question, as a consequence of all that trade noise, we have seen a lot of volumes, as we call them, now move in terms of flowing into the United States, specifically more from Southeast Asia. So countries like Vietnam, Cambodia, Thailand, even India, Bangladesh have benefited from some of these woes.
So we're already seeing countries sort of diversifying away. How interesting is that for you, and how are you sort of tapping into that as DP World?
Well, we're a global operator, and I always say, the world doesn't ride on the business between China and the US alone. There's many more trades and markets that you can still play for. And to be honest, 2026 is a year of growth. Despite the tariff wars, we can still see very good growth, and in some markets, double-digit growth in
That's
terms
incredible.
of trade volumes.
Right.
And it is incredible. Yeah. And some of those examples are Far East into India, Middle East, Far East into Latin America. Those trades are doing very, very well. And the consequence for us is kind of two lines of thoughts. The first one is the role of the Gulf. The Gulf, as we all know, is on the trade route between East and West. And as trade flows into Europe, and if trade flows to Africa and to Latin America, we see an increased role for the Middle East to tap into it by providing superior infrastructure in ports, providing superior infrastructure in logistics, in warehousing, fantastic infrastructure in terms of the ease of doing business and making sure that the supply chain can thrive here and be a part of that. So I think that's the first thing that we see. It has a great economic knock-on effect to this region, ironically, where more is happening. And then the second thing is, we deploy more capital in the emerging markets as a consequence. So our investments into the port infrastructure in Asia, India, Middle East, actually Sub-Saharan Africa and Latin America has seen an increase, partly because of all of this, but also because those markets continue to grow well.
And do you think there's enough confidence in those markets?
I think you'll have to kind of cut it into pieces. I think in this region, confidence is very high. As we all know, one example is that the UAE has entered into a number of, we call them CEPA agreements, so economic cooperation agreements. I think they already have something like close to 30 enforced. And these agreements are really there to make trade between countries more easy. It removes barriers, it removes tariffs, it introduces digital exchange of information. And as a consequence of all of that, what we can see as one example, we run quite a well-known port in our industry called Jebel Ali, just south of Dubai. Today, we have more than 11,000 companies operating their logistics and their needs out of Jebel Ali's free zone. And you can see that within the free zone, a number of things are happening. We see the role of construction materials, the role of machinery, roll-on, roll-off vehicles, the food sector. We see those growing quicker than the growth of the UAE. And that means that Jebel Ali is seen as an increased distribution hub for the wider region and the wider world. And so it has quite some impact. And if you then see which companies are coming, we see more entrants from the Far East, we see more entrants from India, even European companies are entering, so it's quite well spread.
We're going to talk about sort of resilience of the geopolitics in a minute, but I just want to remind the audience, you can ask questions. You can go on the app Slido. Also, hopefully, we'll bring up a code for you to scan from your phones, and we'll try to bring in some of your questions. This is your opportunity to interview the CEO of DP World. I'm sure you're going to have some interesting questions. We'll come to those in a second. But I just wanted to move on and talk to you. I guess what's on everyone's mind at this conference is the geopolitics in the region. And, of course, what I'm talking about is, from sort of conflict in the Red Sea, obviously, and all of the issues we've had over the last couple of years. How does DP World stay resilient and safeguard when you have such sort of important shipping corridors that have basically been closed for a while now?
Yes. The irony of everything is everybody's watching this Red Sea situation and the fact that the ships can't enter from the south in, only from the north in. But all the disruption is already a year and a half behind us. So where it really happened, the big change was November, December 23, and then the first half of 24. Then shipping lines suddenly had to see we can't go in from the south, and that means if you have to go to the Mediterranean or to Europe, you'll have to go around the Cape. And all that change was executed by the shipping lines, I tell you, in a period of 3 to 4 months, quite exceptionally so. And so now the supply chains, although longer, they're quite working and they're quite stable. So for me, when people say, how's it going in the Red Sea? You're going to get a boring answer. The networks have adjusted, it is working, and you get into Europe quite easily. Where it took a little bit more time is to get to the ports inside the Red Sea. So if you look at Egypt, if you look at Saudi Arabia, they were in fact affected more dramatically than Europe. And most of those flows are going around, so it really takes a long way, and then back from the North Suez back in. But also those trades have reestablished and working. But we've also seen smaller feeder companies, new entrants, actually Russian companies. We've seen Chinese companies offering feeder services from the south. So, it has reset, and in that sense, it's quite a boring story to tell today. I think what is on everybody's mind right now is, what if it reopens?
Yeah, exactly.
And it's a couple of things going on here. It's very industry specific. First of all, for the shipping lines, a reopening of the route means many things. You need to readjust your network. You'll have to make sure that as you go from the south through, there's ample port capacity in the hub ports on the way to Europe. And today, that's actually a bit of a problem. We see quite some congestion in the Mediterranean, actually parts of North Europe. And so if that adjustment needs to take place today, many shipping lines won't look at it actually very positively.
Why is there so much congestion?
It's kind of it's the root cause of the congestion is a different one. I'll explain it to you as brief as I can. In the world of shipping, there are 3 large alliances between the shipping companies. And the relationships in these alliances have changed during 2024. And during that change, all the networks were adjusted. And they were particularly hard hit in the north of Europe, where vessels had to change from one partner to another. There were double calls and etc. And then Europe, to be honest, had quite some strike action on the continental side. So all of that exacerbated in congestion in Europe. And so to answer the original question, is many shipping lines don't look too positively in reopening of the Suez like right now. They've already had a turbulent 25, they've had a turbulent 26, and more turbulence kind of short term won't really do any good. I think the second question is, what will the insurance companies say? They have a big say on the premiums going through the Suez, and that may influence you because it will be a cost decision. But then I also know shipping quite well. If one goes, many may follow, and it will happen anyway. So it's right there.
We've got a really interesting couple of questions there. One of them is, how do you see bulk port operations evolving across the world with respect to the UAE?
Bulk?
Yeah.
So that's quite a specific thing. I think for us, the bulk business is in this region the fastest growing business, actually, ironically. So we have double-digit growth in Jebel Ali in a number of commodities from aluminium and what have you. What we see in other parts of the world is that it's a bit specific, but in the world of container terminal concessions, where you are allowed to do other activities, we tend to see interest to secure capacity and to do so. But there's also many places, especially in Europe, you're not actually allowed to diversify, and although there may be a market, we don't. But if there's an opportunity, we tend to do more bulk in our container operations.
Moving away from the UAE and looking towards the global south, do you think the future container business will move towards the global south? Do you think that's the way things are heading?
I don't think it will move, but you will see more growth in global south than the traditional markets. And what that specifically means is the need for port capacity in Southeast Asia, for more privatizations, let's say Philippines, Indonesia, more opportunities, as we talked about, Vietnam. More capacity is needed more quickly. In this region, there's so much great investments happening in Saudi, UAE, Khalifa, Dubai, etc., that it's generally in a good spot to capture the growth. But for us, another example is Sub-Saharan Africa. There is not a single one of our ports in Sub-Saharan Africa, and we run 5, where we're not investing already for the next 5 years ahead because we see that growth coming. And a similar wave is happening on the west and east coast of Latin America. So it's already happening and it's already in motion.
I've been to a few of your ports in Sub-Saharan Africa, including in Somaliland. And I guess one of the things that I think about is, what will be the impact of the energy transition on your gigantic shipping operations?
So, a lot is happening in this space. And of course, we've all seen the news last Friday, where in the end of the day, the IMO had to defer its decision on the carbon tax for another year. So let's see where that goes. It actually doesn't change much for our company. We are not as big in shipping as the global operators. We are more a regional, intercoastal player. But for us, the net zero story actually doesn't change. We stay committed to the net zero aim for 2050. We stay committed to finding alternate fuels, and we stay committed to electrifying our ports. And at least on the port side, we have a lot of choice to make where we can still electrify, source electricity from renewables, etc. So that mission will actually continue for us.
And look, DP World started as a single operation many years ago. And now it really is an integral part, I would say, of the global trade, the economic system in many ways. You've been at DP World for a number of years now, I think almost nine years. You've seen a lot of twists and turns during that time. What do you think will be sort of the key factors at play ahead when you're looking at growth corridors for DP World? And that sort of answers some of the questions as well when we're looking at different routes. Yeah.
I would say the most challenging part for us is to understand where port capacity needs to be in the years ahead. And it's so difficult because you can look at annual growth rate, but if somebody says, can I do more in this port? For instance, we have the example in London. So we run a big facility on the Thames called London Gateway. It is in high demand by clients, and it's in demand probably for the next 5 years ahead. But the challenge that you have is it takes so much time to realize and to build out capacity. So even by the time you say, let's do it, you need to make designs, engineering, contracts, civil building, buying cranes, and you're easily 3-4 years ahead. But you're making dramatic large capital decisions up front. And so for us, that challenge remains. Where do you deploy capital, and how certain can you be that that capacity will be used in a couple of years out?
And how does that sort of involve the public-private partnership?
So this is not new for us. I mean, first of all, we are actually a believer that PPPs really work well in the port industry, because you have basically the government and the regulator on one side, creating that policy and consistency, and then you have the private sector with its capital and the operational expertise to execute. So it really, really works well. And, you know, we have in our company 3 of those platforms that we regularly use. We have BAI from the UK, where we work together, and that's very Africa-focused on our investments. We have our platform, global platform with CDQ out of Montreal, which is a sovereign pension fund in the end of the day. So we work together on a number of projects. And then, of course, in India, we have NIIF, where we work well together on the Indian platform. So for us, it's not a question, does it work? It's actually a proven concept, and we'll do more of it.
We unfortunately are running out of time, so we don't have time to go through those many questions. Thank you so much for those who did post them. Really interesting. I hope we covered some of the answers here. But just want to say big thanks to Tiemen Meester, COO of DP World Group, for joining us here to talk about navigating disruption, rewiring trade and supply chains. A big thanks to you, and also a big thanks to the audience and all those watching. Thank you.
Thank you. Thank you, Nelson.
Good. Thank you, Nazanine. Thank you, Tiemen. Right, we've got one final session before lunch, and we're going to stick with the trade theme and the fallout from the dramatic shift in tariff levels, the unpredictability of where things might go. This panel will explore how businesses and governments are adapting to these changing dynamics and the impacts on global economies, as well, of course, as the inflationary pressure that may well build. It's going to be moderated by the global editor of Reuters Breaking Views, which is our financial commentary arm, Peter Thal Larsen. Come on up, Peter.
Good. Thank you very much, Axel, for that introduction. And thank you all for coming. I realize we're the thing that stands between you and lunch, so hopefully we can keep this interesting and snappy and give you plenty of food for thought, if nothing else, in the next half hour or so. We've got a very distinguished panel here to discuss the question of tariffs and trade shocks. Joining us in the room here is Luigi Di Maio, the European Union's Special Representative for the Gulf region. And then on the screen, we have Her Excellency Rania Al-Mashat, the Egyptian Minister of Planning, Economic Development and International Cooperation, who's joining us from Brussels and is on quite a tight deadline. So she may have to leave the panel a little bit early. So if she suddenly disappears, don't be alarmed. And also, we have Nasser Saidi, who is the founder and president of Nasser Saidi and Associates. So maybe, Your Excellency, if I can start with you, given the sort of the time pressure we're facing here, I'm just curious for your perspective on how it's been a very momentous year in terms of trade and tariffs. Every day, something new kind of comes along. I just wonder how the shift in terms of tariffs and trade fragmentation from your perspective has affected the Middle Eastern region and how the region has responded to the resulting economic challenges.
Well, thank you very much. Pleasure being with you this morning from Brussels. A few points. We just came back from the IMF World Bank meetings, and there was an update with respect to global growth and also the trade trends. What is for sure is that we have better outcomes than we had a year ago. And even though global growth is expected to be lower than initially, but better off than what we thought last April. So that's takeaway number one. The second point, when you take a look at the WTO's outcomes with respect to trade, you'll find that there has been more regional trade taking place. There's been more front loading in anticipation of greater tariffs that are going to come along the line. And maybe when I look at countries in the region, our country, Egypt, or developing and emerging economies, you'll see that there was a very important push and momentum for trying to do structural reforms faster in order to attract a lot of the FDI that can actually, manufacture to re-export. So even though it was a year of a lot of uncertainty with respect to what's happening on trade, but it did allow for, I would say, faster movement and also regrouping when it comes to finding, markets to deal with. In our case, for example, Europe, and we're, today we have the Egypt EU summit, which is taking place. Investment and trade are a key component of it, in addition to other items. So this is, again, an opportunity for countries to do their reforms faster, push their competitiveness in ways that may have taken time earlier. And third, try and regroup with regional and maybe, the either unconventional partners or those who are conventional, but try and do things with them faster to be able to overcome and mitigate the implications of what we're seeing globally.
Yeah, it's very interesting, Luigi, to hear Her Excellency say that actually the outcome is better economically than it was a year ago. I mean, because you would expect, given everything that's happened, that it would be the opposite. How, from the EU perspective, how have these sort of shifts affected the dynamic, and particularly in relation to the trade relationships with the region?
Yeah, thank you very much for this question. I would say that since this unpredictability on the market started, and is even before, let's be honest, before the election of President Trump, was clear that the deglobalization was coming, was increasing in terms of effects on our markets. Since this kind of shift started,